Money Mentor. Grab a beverage and join me for another relaxing video. Cheers. We'll get started in just a moment. But first, remember the trigger of the week. What did you think of my video yesterday? Was it relaxing watching me clean my couch? I hope you enjoyed it. I'm going to be creating a lot more videos that are perhaps not talking, just designed to help people relax, because money can be very daunting, I think, for a lot of people. And sometimes it's nice just to sit back, relax, and not think about it at all. So I'll be blending a lot of content together into hopefully interesting content for you to enjoy. Part of my trigger this week, remember, was also this that was inside the box. And this styrofoam as well. Shh. Relax. We'll be talking about the best things you can do in a volatile market. But here's the fact, remember. Put your phone on your nightstand and perhaps fall asleep before we get started. Remember, give me a like right now. YouTube has been recognizing all of those likes and sending my videos to more people through impressions. So the more people I reach, the more they're going to see this message of trying to attain financial independence in your life, because that's what my channel is all about. So hit like for me right now. And I hope you also subscribe to my channel as well. So today, to wind out the week, which may have been another volatile week, I don't know, because I produce these episodes a little bit in advance, as you know. So I may pin a comment to my videos this week just to acknowledge perhaps like what the market is doing. I was going to do that last week too, but I decided, you know what, Evan, wait till the end of the week because it was just so volatile. And on Monday, I gave you the outcome of where the S&P 500 landed as of Friday the 11th, and now here it is, Friday the 18th. So at the time that I'm producing this episode, I do not know how the market performed, but I hope it did better than the week prior. But maybe it was another volatile week, and if it was, I want to wind out this week by talking through 5 things we should do in a volatile market. So number 1, I think we should all keep perspective. Just remember, and many of you know this, but down times are very normal. Historically, stocks are down 5% 3 times during the year. We may have one correction of about 10% every year, and one correction of 15% every 3 years. Anything beyond 20% is really technically like a recession. But these corrections are kind of normal. And I think we did get close to 20%, and then it went back up. So, we're going to hear in the news if we're in a recession. Some people think we are, some people think we're not. There have to be so many quarters of down markets for them to technically say that we are in a recession. But regardless, the market is very volatile as a result of several things, one of which are the trade wars that are going on right now as we speak. So, again, keep it in perspective. Don't stop investing just because you're scared of the markets. Number 2, get a plan that you can live with, a mix of stocks and bonds that will determine your potential returns, of course, but also swings in the market. The more conservative, the less the swings are. And so if you can't stomach this kind of volatility, then you would probably want a more blended portfolio. It also depends on how old you are, right? But that's not always the case, because many of you know that I'm currently in 75% stocks, 25% bonds, but I did that because I have money in different buckets that I need at different periods of time. And what was I going to say? I'm sorry. My traditional IRA, I won't need for a very long time, and so that is more heavily in stocks right now in a target fund. The reason why I'm hesitating right now a little bit is, I told you last time, I recorded these videos, but I had an audio problem. So I'm having a hard time remembering what I say. Did I say it in my last episode that I recorded that's good, or was it in the one that was bad? So let me just repeat something that you may have heard on Wednesday. I'm not sure. But even though I'm 75% stocks, 25% bonds, did I tell you that my Vanguard Roth IRA actually made $1,800, even though we've had all this volatility? That's because it's very blended in bonds. I think it's 50-50. And so, because that's the first account I may tap on, in addition to the taxable account, to qualify for ACA if I need to, or I'll use earned income, as I talked about on Wednesday, if I go back to work. But the Roth IRA really is that first account that I will be using once I start pulling from investments, which you guys know might not be for another 2 years or more. This year, 2025, short-term reserves. 2026, short-term reserves. That's why I'm trying to stretch out, as I talked through on Tuesday's episode, the short-term reserves, but I don't want to deplete it completely because I'm going to need it for future downturns. So these are all the things you start thinking about if you retire early. I joke around with some friends of mine and I say, you know what, I should have just kept working and not worried about all this stuff, which is kind of interesting. But back to number 2 is to have that plan. And again, even though I am going against traditional wisdom in terms of having so much stocks, I did run it by, I think I told you, with Vanguard and with Fidelity, and they agreed if you don't need that money for 15 years, then having it more weighted in stocks is perfectly fine. You have time to recover. Number 3, for the best things you can do in a volatile market is focus on your time in the market. Like while you're young, right now, if you are young, you've got plenty of time. Continue investing. Focus on that. Don't stop investing, right? You might have things pop up in your life. You want to buy a house. You get married. You have all sorts of other things going on. That is true, but continue investing. Don't stop. Don't also try to time the market either. Some people, as you know, you probably saw in the news, they were pulling their money out of their investments. They were selling. But then they would have missed that 9.5% gain that we had in one day, which I think I saw in the news was like the That only happened one or two other times in history. So if you would have sold all your shares, you would have missed that return, even though it went back down. Anyway, not as far as it was, at least as of Friday the 11th, which is my knowledge of how the stock market has done since I'm producing this episode early. Anyway, number 4. Invest consistently, even in bad times, like what we are in right now. The best time to buy, as you guys know, is when the market is down, so continue dollar cost averaging into the market. Let me give you an example. I had a question on one of my episodes, and I wrote a comment back, and I wanted to share with it right now. Buying the dip. This person asked me, what does it mean to buy the dip? Well, because the market went down, as I just mentioned, you're buying more shares with the same amount of money. So I wrote back to this person and I said, you know what, if I was still working, I probably would have changed my strategy just a little bit. I would have continued to dollar cost average with my Roth and my 401k, which I did for years. But remember, I shared with you my taxable account. I used to put a lump sum at the end of the year. I would have changed that strategy and I would have put in increments every month. Because let's say you have $5,000 to put into the market at the end of the year. Well, chances are you have some of that money throughout the year that you are earning. So why not put in 500 here, 500 there? Then you're buying the shares when the market is down because you're capturing more of the shares, and that's what you want. You want to buy low if you can. You're not going to time the market, but if there is an opportunity for you to buy the dip, that's what that means. So for many years I was just doing a lump sum at the end of the year because things were going up, and I just decided, well, I wanted to make sure that I had enough money for emergencies, etc. So I just kept it and I did a lump sum. But again, I probably would have changed my strategy and I would have dollar cost averaged in with my taxable account if this would have happened when I was working. And finally, number 5 on best things you can do in a volatile market is, don't be afraid to reach out to people and get help. Talk to Vanguard if you have money with Vanguard. Talk to Fidelity if you have money with Fidelity. Talk to Charles Schwab if you have money with Charles Schwab. Pick up the phone. Talk to their investment people. Even if you don't have money under assets under management, you can still talk to them and get a little bit of insight into what might be the best thing to do with your money during volatile times such as what we're in right now. And talk to a lot of people. And then take that information and then you make the decision on what you truly want to do, because nobody is going to do better with your money as long as you're educated and you make the choices that are right for you. For example, you guys know when I liquidated my 401k, I did talk to Fidelity. I did talk to Vanguard. And then I made my decision. I decided not to go into those managed funds, which had a higher expense ratio, and I went into index funds. One caveat while I'm thinking about closing out today's episode is that I did see recently that index investing for the next 10, 15, or 20 years is still very good, and I'm always going to believe in index investing, which means you're putting your money into index funds that ride the S&P 500, for example, or other indices. And I'm not going to really believe in managed funds, but managed funds can be good too, because even though you're paying a little bit more money in an expense ratio, they are managing those assets with a proper mix of stocks and bonds and making decisions for you. However, if you're in certain funds within accounts, like for example my Roth, I have 2 Roth IRAs, one with Vanguard, one with Fidelity, and I have a traditional IRA. At any time I can click buttons and I can purchase mutual funds that may be weighted differently in stocks and bonds, and I can do my own balancing through difficult traditional IRA to something a little bit more conservative, to save on losses. But then I said again to myself, Evan, you've got 15 years before you need that money, so just relax, right? So I just kept it where it was, but I'm using my head, and I want you guys to use your heads as well, right? When you're thinking about your money, don't just rely on index funds. Yes, buy and hold is good, but always be thinking about the most efficient things you can do with your money, because again, nobody is going to take care of your money better than you. So with that, everybody, I think I'll go and close out this episode. I believe in you guys. I congratulate you on every step of the way. If you like content like this, give me a thumbs up. Consider